Next week, the leaders of the world's two largest economies will be meeting as U.S. President Donald Trump travels to Beijing to meet with China's Xi Jinping. So, what is at stake for the markets and investors? Joining us now to discuss is Haining Zha, VP and Director of Asset Allocation with TD Asset Management. Great to have you with us, Haining.
Thanks for having me.
Let's dig in here. Actually, before we get to what might transpire next week, we've had some news that Beijing now telling its domestic companies not to comply with U.S. sanctions on 5 Chinese oil refiners. How does this start to cast the mood over what is to come?
That seems a little bit ominous, but in our opinion, it is not very unlikely to derail the whole situation. Actually, looking into the next Leaders Summit, I think the number one thing that investors should watch for is whether this general détente between the two countries will continue. It is very important because the market consensus, it will continue that way, and it's already been priced into the market. So if it's severely disappointing, then that actually can create more volatility in the market. But on the other hand, if the general direction can continue, even certain detail could underwhelm, but overall it will still be a very favorable environment for the investors.
Okay, so that's sort of the backdrop in terms of the mood between the two countries. When we start talking about what could come out of this summit, I guess maybe a bit of a checklist. What should investors be watching for?
Right. There is a list of items on the agenda. For example, soybean and a general agricultural product, Boeing aircraft orders, and then the rare earths, and also the chip and the semiconductor manufacturing equipment. So all of those things will be on the agenda from the commercial side. And on the geopolitical side, of course, Iran and Taiwan will definitely be, the topics that leader will discuss.
All right, I start breaking some of them down then, because you gave us agriculture, you gave us microchips, you gave us aerospace. We'll start with agriculture. Can a deal be made here, and how might that play out?
Yeah, we are pretty optimistic on that. One of the key reasons is China, is one of the largest global importer. Take soybean, for example. In soybean, China is, import 60% of the global soybean. Since the first of the trade war, U.S. market share has completely going down. So cumulatively speaking, its market share has dropped by 15%, losing basically to Brazil and Argentina. So of course, it will be, easier for U.S. to catch up on that front. And also, I think from the China side, it's also not a difficult target to achieve. Remember, since October last year, after the Leaders Summit, there seems to be two targets set. One is the near-term target, which is by January of this year, China should purchase 12 million tons of soybean. Based on the private sector tracking, that target is pretty much achieved. And the second target is the medium-term target, which is from 2026 to 2028. The annual minimum purchase should be around 25 million tons. And in our opinion, it is not a difficult target to achieve, because if you look at the average importing volume from U.S. to China, from 2020 to 2024, the average level is around 26 million. So, the minimum target is below that. So it doesn't take China a lot of effort to achieve that.
All right, so there might be some progress there. You talked about microchips, and we know the two countries have had their issues there. You say that when it comes to China, the AI boom, and that's what the microchip play has been all about, the AI boom, has played out a little differently for Chinese equities versus the American ones. How so?
Right. So the perception of the market is, or the crowd, is that the U.S. is leading the pack in terms of AI and all of those computing. And China is a close second, way better than everyone else. And given the fact that the Chinese large tech firm is dominating the Chinese equity market, and also the fact they are trading at lower valuation, it seems like the setup is pretty promising. But look at the year to date, the performance-wise, it actually play out quite differently. So year to date, MSCI China is actually down 5% instead of going up. So we think there are several reasons for that. So the first reason is, other than the AI segment of the business, for many large Chinese tech firms, they have other core segment, which is under the pressure of the macro economy in China wasn't very strong. So take Alibaba, for example, their core retail e-commerce year-to-date volume is pretty soft. The second reason is when the large tech company invest in AI, people naturally have this doubt on ROI, whether the company can get return for the investors. So we see similar trends actually play out in the US market as well. So take Alibaba, for example, for the next 3 years, they're going to invest about 380 billion RMB into AI. Whether it can generate return, that's a question mark. And the third factor is that if certain company don't invest in AI a lot, then that will also create a question whether they will be disrupted down the road. So take Tencent, for example, their capex is trailing Alibaba and also ByteDance. So that's why investors have their doubts on whether Tencent can keep their dominance in the social media platform and other business. So that's the third worry. And lastly, there are a group of new companies that got listed in Hong Kong, and they represent pure play for AI. So investors' incremental dollar are attracted to that segment of the market.
Will the Americans see this Chinese push into AI as a threat? And could that be something at the summit that might be a sore point?
Yeah, so they would certainly U.S. view China as one of the biggest adversary, especially in the AI technology. So U.S. will continue to move forward, and hopefully with abundance of compute, they can, hopefully creating a bit of distance to make them comfortable. But I think it is actually working the other way. So because it is trying to lock down China out of those technology, China is actually working very hard on self-sufficiency. So right now we are seeing this year Huawei's new AI server will go onto the market, and it is noticeably better than the last generation. And that trend probably will continue.
Let's talk about the aerospace piece. Do you think you can see any deal making there?
I think it will be a little bit tougher because, first of all, Boeing's last major order was back in 2017. So it's not purely because of the trade or the geopolitical tension, but also because Boeing has its own safety concerns. So we have to wait and see. But obviously, people are talking about it. There are some discussion of Boeing 737 MAX deal that could happen during the Leaders Summit. But over the years, Airbus has been consistently gaining market share. Just last month in April and also in March, some Chinese airlines in total purchased about 37 billion of Airbus aircraft, which is a major concern for Boeing.
Okay, lastly, I want to talk about the fact that the geopolitics side of this, obviously what's happening in the Middle East has created a surge in energy prices. China is feeling that pain. How is the economy handling the current energy shock, and how much will that sort of weigh over these talks?
It definitely not as in good as a position as the oil exporting countries or oil sufficient country like U.S. and Canada. But among the oil importing country, I think China is probably the best position. The reason is that the China created reserve of almost 1.4 billion barrels of oil. So if you look at that, the reserve, so there are several ways of calculating it. So crude oil accounts for roughly 15% of the China's total energy demand. And the oil from the Middle East accounted for roughly 40% of that. So on a daily basis, China need to import about 6 million barrels of oil from Middle East. So if you completely cut that off, so 1.4 billion of reserve, if you simply do the back of envelope calculation, it's enough to last for 8 months. But also that's a very extreme assumption because not all of the oil is actually cut off. Actually, the war broke out in March, but the March import was completely unimpacted. So it really got worse in April, but even in April, not all of the oil importing is cut off. So, the Yanbu pipeline still has 7 million barrels per day, and the Fujairah plus Oman, they also have 2 million barrels. So if you assume, say, 30–40% of those amount go to China, which is roughly the same percentage as the total oil export from Middle East, then the only gap is probably around 3 million barrels, which is enough to last China for about 15 months. So which is a good position to be in.